Have you ever looked at the cash sitting in your bank account and felt a lingering sense of unease? You are not alone. There's a quiet realization among successful individuals that while having cash on hand provides peace of mind, letting too much of it sit completely idle is essentially paying a silent tax on your hard earned wealth. Inflation constantly erodes the purchasing power of every single unit of currency you own. If your cash is not actively keeping pace, your wealth is effectively moving backward. Welcome, I am Kunal from EPK Capital. At EPK Capital, we build wealth for generations. Over my 2 decades in wealth management, I have found that one of the most critical, yet frequently ignored aspects of financial planning is optimizing where you park your liquid capital. It is not about timing the stock market or chasing high risk bets, it is about managing your safety net with strategic intelligence. Today, we are going to dive deep into a vital comparison that every modern investor must understand: high yield savings accounts versus money market funds. By the end of our conversation, you will know exactly how to structure your cash reserves to maximize returns without compromising your safety. Let us start by breaking down the option most people believe they understand perfectly: the high yield savings account. When we talk about a traditional savings account at a legacy brick and mortar bank, we are often talking about a place where money goes to sleep, frequently earning a fraction of a percent. A high yield savings account, or a short form high yield account, is entirely different. Driven by digital first banking and highly competitive neobanks, both globally and right here in India, these accounts offer significantly higher interest rates than your average standard account. They achieve this because digital banks do not have the massive overhead costs of running thousands of physical branches, and they pass those savings directly back to you in the form of better rates. From an investor's perspective, a high yield account is the ultimate comfort zone. Your money remains completely safe, it is highly accessible, and it earns a predictable return. It functions exactly like the regular bank account you have used your entire life, but it works significantly harder for you behind the scenes. It gives you a clean, safe, and comfortable place to keep money that you might need at a moment's notice. Now, let us pivot to an alternative that many affluent families use, yet remains surprisingly misunderstood by the general public: money market funds. When people hear the word fund, they often immediately think of the volatile stock market, fluctuating prices, and sudden economic downturns. I want to clear that misconception up right away. Money market funds are not stock investments. They are a specific, ultra low risk category of mutual funds designed explicitly for capital preservation. Instead of buying corporate shares, these funds pool investor money to buy very short term, highly secure debt instruments. We are talking about things like government treasury bills, certificates of deposit from massive commercial banks, and high grade commercial paper issued by top tier corporations. Essentially, you are lending your money to institutions that are virtually guaranteed to pay it back, and doing so for very brief periods, often ranging from just a few days to a few months. Globally, and within the Indian financial landscape, money market funds regularly deliver highly competitive yield ranges, often hovering beautifully between 6 and 7%, depending on prevailing market conditions. They offer a sophisticated, institutional grade vehicle for parking cash that bypasses the traditional banking middleman completely. Now, as a bonus, I have created an in depth guide to the 7 costly tax traps for high net worth NRs, a strategic report on avoidance and compliance. You can download it simply by clicking on the link in the description. Let's continue with our discussion now. This brings us to the core face off: how the yield and interest rates actually operate in both of these environments. To truly appreciate this, we need to look under the hood at how these two options react to the broader economy. Commercial banks are notoriously slow to raise their savings account rates when a central bank raises interest rates, yet they are incredibly fast to lower them when rates drop. They have profit margins to protect. Money market funds, on the other hand, are directly tied to the pulse of the live debt market. When central bank rates move, the yields on the short-term instruments inside a money market fund adjust almost instantly. Let us walk through a simple, real-world scenario to see how this plays out. Imagine you are holding a substantial cash reserve of 1 crore rupees, or roughly $120,000, earmarked for a property purchase or a business expansion in 2 years. If you leave that money in a standard account earning 3% versus a high yield vehicle or a money market fund yielding 6.5%, the gap is glaring. A 3.5% difference on a reserve of that size means you are leaving hundreds of thousands of rupees on the table every single year. Over a multi-year period, that gap expands significantly, directly impacting the foundational growth of your family estate. Of course, yield means nothing without safety and liquidity, so let us put both options through a strict security check. When you place your money into a high-yield savings account, your ultimate shield is government-backed deposit insurance. In India, under the Deposit Insurance and Credit Guarantee Corporation, your bank deposits are insured up to 5 lakh rupees per bank. Globally, systems like the FDIC offer similar structures up to $250,000. This means even if the bank completely collapses, the government steps in to make you whole up to that legal limit. Money market funds do not have government insurance, but they protect you through an entirely different mechanism: massive diversification and extreme credit quality. Instead of putting your eggs in one bank basket, a money market fund spreads your capital across dozens of sovereign and ultra secure corporate debts. The structural safety is exceptionally high. When it comes to liquidity, meaning how fast you can get your cash in an emergency, both perform brilliantly, but with a slight operational difference. A savings account gives you instant access via an automated teller machine or a mobile app check transfer. A money market fund usually requires a redemption request, which typically settles within one business day. It is an incredibly small trade-off for a significantly optimized yield. There's an old vital rule in wealth management. It is never about how much you make, it is always about how much you actually keep after everyone else takes their cut. This brings us to the hidden impact of taxes, which can quietly destroy your returns if you are not careful. In many jurisdictions, including India, the interest you earn from a standard bank account enjoys minor exemptions up to a certain limit under specific tax laws. But any substantial interest earned beyond that minor threshold is added directly to your regular income and taxed at your personal slab rate. For a high-earning investor, this means a significant chunk of your interest can be eaten away by taxes. Money market funds are classified as debt mutual funds. The returns you earn are taxed based on your holding period and prevailing regulatory guidelines. For short-term cash parking, these gains are typically taxed at your income slab as well. However, the true strategic benefit comes from how the yield is compounded and managed inside the fund, allowing for tactical timing on when you realize those gains. When you are looking at managing generational wealth, understanding these subtle tax nuances ensures that you are not accidentally eroding your capital through inefficient structures. So, how do we translate all of this educational material into a highly practical, actionable roadmap for your personal finances? The secret lies in a balanced split strategy. You should never view this as an all or nothing choice. Instead, think of your cash in two distinct buckets. The first bucket is your immediate emergency capital, the money you need for sudden lifestyle expenses, medical emergencies, or immediate operational needs. This bucket belongs in a reliable, high-yield savings account where the liquidity is instantaneous and guaranteed by deposit insurance. The second bucket is your tactical investment capital, money you are holding for upcoming tax liabilities, business investments, or market opportunities over the next 6 to 12 months. This larger bucket is far better suited for a money market fund, where it can capture market-driven yields and actively protect your purchasing power from the destructive nature of inflation. I want to challenge you to take action today. Take a close look at your current bank balances. Audit how much of your wealth is sitting completely idle, earning suboptimal returns simply out of habit. If you want to move beyond basic accounts and design a sophisticated, highly customized cash management strategy that aligns with long-term security, our team at EPK Capital is always here to guide you. Let us ensure that every single asset you own is working purposefully toward building a legacy that lasts for generations.